Hello viewers, in today's video we are going to learn how to make the most out of market corrections. What should be our strategy? Should we empty our portfolio, stay out of the market or continue investing? So let's understand this in this video. Let's also get an idea of what a market correction is. It can be defined as a sustained decline in the value of a market index or stock price of a company. There is no universally accepted number for market corrections. However, generally speaking, a 10% fall amounts to correction, 20% fall is said to be a bear market, 35% fall indicates a market crash, and a 50% is called a recession. For investors, market corrections are quite scary, and if we look at the historic data, then the Nifty has seen 19 such corrections in 2 decades. But stock markets eventually recover within a few months of correction. As per one research, it shows that the average Nifty correction is about 14%, and the correction lasts for 2 months before any meaningful upswing. The recovery is pretty swift, especially if the correction is due to some political events or external events, and it is not a bear market. Statistically speaking, bear markets occur once in every 3 years and it takes 8 months to bottom out. This goes without saying that bear markets and corrections are an integral part of the stock market and we cannot escape from it. Likewise, the recovery is also inevitable since the markets have given 7 times returns in 5 years from 2003 to 2007. Let's look at some of the factors to keep in mind in the event of such bear market or corrections. In the event of a correction or bear market, majority of investors get nervous and scared when faced with portfolio losses. The natural reaction is panic, and many investors sell most, if not all, their portfolio holdings. Historically, this act has turned out to be a huge mistake on almost every occasion, and here are a few tips to curb such temptations. Tip number 1. Don't look at stock prices too often. You see, it's pretty evident that when the major indices are tanking, it is most likely that your portfolio will also replicate that, and checking will not really help your cause. Instead, try to remember the investment thesis on the basis of which you have bought those stocks. Tip number 2. You have to remind yourself as to why you started investing and your long-term financial goals. As you know that every correction has been accompanied by markets recovering and even delivering superior returns. Nifty has delivered 11% CAGR returns, making patient investors wealthy 14 times the original investment. Thirdly, you have to keep cash on hand to buy potential cheap businesses during corrections to create wealth. When I say cheap, it doesn't mean cheap on price, it means cheap on valuations. Secondly, buy stocks of strong business pedigree. There is enough historical evidences that strong businesses always generate lot more wealth. Ironically, when market corrects, most investors gravitate towards weaker businesses in the hope that they would create more wealth since they have fallen most and would have bigger upsides. The names provided in the slide is for educational purposes and do not constitute any recommendation. In addition to this, investors will have to be patient enough to be which is absolutely necessary for wealth creation. Many investors invest in low quality stocks during bull runs and get stuck with it during corrections. When the market does pull back from the corrections, it is better to get rid of low quality stocks and the resulting capital should be invested in high quality stocks which might be available at cheaper valuations. While we understand that selling at a loss might be a tough thing to do, however, investors are not aware that taxes can be saved by setting losses against gains made in other securities. Please comment if you would like to know more about tax loss harvesting and we can try to make a separate video on it provided we receive responses from you. Market corrections provide an opportunity for investors to align long-term goals and risk tolerance levels. So what happens is during bull runs, your portfolio allocation becomes skewed more towards equity and less towards debt rather than your preferred 60-40 allocation. This signifies that your risks are more than your initial allocation. Another thing is that most of us invest in different asset classes like domestic equities, PPF, EPF, debt funds, gold, international equities, real estate, and so on. So during market corrections or bull runs, most forget the thesis of allocation and become susceptible to risks. Thus, it becomes important to assess one's portfolio regularly and rebalance its asset not only reduces risks but also ensures you are less likely to make emotional investment decisions. Our experiences tell that market corrections make first time investors realize what risk tolerance is all about. People who cannot swallow the volatility would end up quitting the market. And people who go through this phase tend to have better understanding of the importance of risks, asset allocation, rebalancing, and downside protection. The SIP works on the principle that you accumulate more units when the markets are down and vice versa. This zigzag approach averages out your acquisition cost over a period of time, thereby creating wealth in the long run. Let's go through this by an example. The blue line is a Nifty actual performance over a 16-year period with ups and downs wherein your units get accumulated in downtrends and you get less units during uptrends. Assuming you enter into a monthly SIP of 10,000 per month, you would have made a CAGR returns of 14.3%. Now the brown line is a hypothetical Nifty index wherein there is no major jitters or downsides. Here you only stand to gain 12.9% as compared to 14.3% returns. So this proves that continuing to invest in uptrends and downtrends through SIP creates a healthy corpus and achieves your long-term financial goals. Now, as already discussed in one of the previous slides, that it takes an average of 8 months for the markets to bottom in case of a bear market. However, it is interesting to know that market takes an average of 16 months to make an all-time high. Now, since this is just an average, it can be all over the place with the shortest duration being 2.5 months and the longest being 5 years. This also depends on the economic situation and the depth of correction. Nevertheless, it is safe to assume that corrections or bear markets are a part of stock markets worldwide, and you can create a healthy corpus by deploying the information given in this video. Now let's recap what we have understood in this video. First of all, bear markets or corrections are quite normal and an integral part of the stock market. Second thing is, don't panic during turmoil or downtrends because you are bound to see portfolio losses during this period. But if you be patient enough and build your portfolio by continuing your SIPs, you should do good. By strong business I mean blue chip companies which have consistent track record. You can also use a strategy of tax loss harvesting. If you have gone through any losses, you can set aside any gains that you have made on other securities. You have to manage your risk and assess your asset allocation properly. Otherwise, you may be in danger. Finally, you have to continue your SIP during downtrends as well as in uptrends and stay invested for the long run. Thank you for watching and have a great day.